I'm Grain of Salt. We're at Strategy World 2025 in Orlando, Florida. This particular podcast may be recorded. We're gonna talk at our speed, and if it's too fast for you, then you could slow it down. We just need to cover a lot of ground very quickly. I made a conscious decision in August of 2024 to have my posts sometimes only appeal to 1%, and I've been looking for those people that I could find that understand sometimes what I'm saying, and I believe that you're one of them. What is your name? Javier.
Yes.
Okay. What do you do?
So I'm the Chief Investment Officer of XBTO. So basically we run an asset management business and a capital market business. I mean, our DNA is that we are quantitative investors. So I used to, basically all my professional career, I used to work for Goldman Sachs. I run the QIS and EMEA. I'm basically based in London, so the Quantitative Investment Strategy Group. Before that, I was responsible for BGI, Multistrat, Barclays Global Investor, Multistrat, and Quantitative Investing, yeah.
Awesome. So I just saw your presentation and you talked about volatility.
Correct.
How you manage your customer accounts. And you were talking about selling volatility.
Correct.
Can you give me a little bit of a background on that?
Yeah. So basically what we think it is that, the premise or the prior here is to make sure that investors actually put the coins to work. Okay. So, and we know that the majority of they perceive to be the volatility of Bitcoin to be high risk. And what we think about this volatility is just basically an advantage to us. Okay. So technically it's like a sort of energy that you can harvest if you know what the risk you're taking. Now, what we think about it in terms of selling volatility, to answer your point, is that, people can actually use it strategically as a way to define points of entry. So if you want to buy Bitcoin and you said, I'm going to pay the current spot price, or I may want to actually have an idea that I think probably the level of 85,000 makes more sense in the current situation that I wanted to do. So can I actually sell a put option, okay, that allows me to potentially buy that level if it happens, let's call it in a week or in 2 weeks or whatever is actually the term that we're going to define that option. So that will actually be compensated for you taking that risk of buying BTC at 85 as opposed to actually currently doing now. All right. So that's going to actually be perceived as a yield. Sorry.
Totally get it. So when I watch this presentation, on the other side of the trade, now, what's interesting about this is that you're not really the other side of the trade, is that the market makers, whatever position I take out, whenever I buy options, and by doing that, the market maker automatically delta hedges whatever I do.
Correct.
Right. And on your side of the trade, you're selling volatility, but then some market maker delta hedges what you do.
Correct. Well, I mean, assuming that we're actually going to be back to back.
Sure.
Correct.
I totally get that. What type of returns does your fund generate over a year or two?
Yeah, that's great. Great question. I think basically we try to actually do it in a modest way because, I mean, if you think about it, the primary objective here is not lose the coins. Okay, so you want to generate some modest amount of risk. Okay, then we're going to talk about basically targeting between, let's call it 8 to 10% annualized return, and that's what we actually kind of achieving at the moment.
But you try to be almost riskless with that. 8 to 10% returns, almost riskless.
Correct.
And that's the difference between being an individual investor. Yeah. Doing this is that your clients will not tolerate that loss. Is that the problem?
It's that the idea is that you want to make sure that the clients will not lose that coins. Okay, so but yes, just your point is correct. You don't want to actually lose 10%. All right, so let's say, for example, you get exercised and the market continue to go in a downtrend. Okay, and you basically maintain an excess exposure that is actually going to have basically offer just some negative returns. In other words, your delta is going to be significantly higher. Okay, so there is a way for you to kind of make sure that you manage that delta, make sure that you don't have leverage into that. Okay, so there's ways that we actually implement that to make sure that.
Of course. So what's the difference between a bear market and a bull market for your strategy?
So that's a great point. If you think about what do we do, I mean, it's like we said that we're not constantly selling volatility all the time. So, I mean, probably you heard that in my presentation. What we're actually trying to do is just to make sure that when we sell vol, it's because we think that the risk and return profile of selling that vol is actually appropriate. That means the level of volatility is appropriate, okay? 2, where we are in the market conditions, okay? We are in a market conditions that we can think about actually is the right set of market conditions. I mean, we're just going to be selling, just to give you a silly example, are we selling volatility before the CPI number, for example? Are you going to do that? Probably no. Okay. Are you going to do that? We go to other mechanisms. For example, we have very short dated signals in terms of trend following that allows us to say, okay, well, if you are in a low, if you're basically in a negative trend following in our signals, why would you actually sell? You know that more likely that you're going to be exercised. So there's no need to actually take risk at that point in time.
So you stay on the sidelines sometimes.
Correct.
Right.
Correct.
And then when you sell your volatility, what percentage out of the money do you typically look for?
Well, basically, the definition of the deltas, we usually around 35%. Okay, is going to be in function of what the risk and return profile that we basically have. Okay, so I mean, we do that for as well, not only for commingled vehicles, but we do it for separate managed accounts. So people would actually have several different. But if you could actually think of between 35 deltas, I mean, that's what we're going to be technically doing.
Yeah, I use different metrics than you, but
okay,
but
that's fine.
I think that's why I liked your presentation, because it was a different. It was the other side of the trade. Your metrics are a little bit different than.
Tell me what you do. Tell me. I would love to hear.
I look at the entry price, and in my view, I've coined a term called full gamma. And what full gamma means is that if you buy 10% out of the money, strategy is trading at $400, I would buy a 440 call.
Yeah.
And then I also then wanted to go 10% in the money, and 10% of that, would be 484, and that would capture full gamma.
Correct.
Now it would be more risk with more return to go 20%. If the stock is at 400, buy it at 480. Right, and then 20% of that would mean that it would have to go to $100 higher, so it's 500. And that captures the full gamma of both of out of the money and in the money, and gets the intrinsic value. And so what I learned from the fourth quarter that was for different purposes that we talked about that I would rather not say is and it's so from that perspective, I had different motives in the fourth quarter was that. That volatility that was happening from my perspective, I think the interesting part, in fact, Dan Hillary said, the implied volatility was 220% versus the historical volatility being 110%.
Yeah.
And he goes, well, that was a signal. And I'm like, really? 220 divided by 110?
Yeah.
And I go, that's 2. And he goes, really? And I go, but we already knew that in the first cycle, compared to the 50-day moving average of the price, it was 2.37 in April.
Yeah.
Just the price of the stock.
Yeah.
And then in fourth quarter, it only got to 2.12.
Yeah.
So comparing the stock price versus the 50-day moving average was almost exactly equal to the implied volatility.
People tend to get fixated with those basically exact numbers,
right?
But
and that might have been a stroke of luck that if it was different. But it was so funny that those multiples were almost about the same.
Yeah.
And so for us, because it did not exceed what it did in the early part of the year, we thought there was more upside because we were hoping that this would be a gamma squeeze going into January.
Yeah.
And even then, my shortest dated call was still 60 days out.
Yeah.
It wasn't that I never buy weeklies. I never buy anything unless it's always 60 days. What I learned after this is that my shortest dated call now is minimum of 120 days out.
Okay.
If not 180.
All right.
Right.
Okay. That's
and so that was the difference. If things go into something bullish, and I ask your view on this, not financial advice. After using Achilles Intelligence, keep, for instance, if there's two call options.
Yeah.
Let's say it's $440 for January. What I would rather do is, instead of buying a $540 call option for the same expiration, I would rather move it up. Move it up by a month or two. Based upon our analysis, I think that's more likely to go in the money as opposed to buying a higher strike for the same expiration in our analysis. And I don't know if that's just a function of just MSTR, the way it trades.
It looks pretty likely to be the case. And the other thing, when I was hearing you, I was just kind of wanted to ask you why you don't do Bitcoin optionality. And I guess
I'm going to tell you the reason why. Because I'm a retired tech guy. So what happened was 99% of my wealth up until 2021 was all in an IRA account. So in order for me to take out the vast amount, the money that I had,
you have to
I have to pay taxes on it and 10% penalty. And I live in California. Massive. So for me to buy native Bitcoin would be very expensive.
It's expensive.
Right. So everything was
SFG is perfect.
And that's why I don't really consider myself a traditional person.
Yeah.
But I had all my money in the traditional markets.
Yeah. Yeah.
I never.
I think what you actually find is you find the right vehicle to be able to do exactly what I was just saying to people in the presentation.
Exactly.
No, it is exactly right. Now, what I ask you that question as well is because, to go back to your point, what of the two options will actually probably be better? And I think it is just what you actually have is very intrinsic to the characteristics of MSRT. But there's so many other stuff that is actually happening around, seasonality of weekends, and happens that stuff that I'm pretty sure you're familiar with that actually are pretty interesting in the terms of BTC. And the reason is because the ability to trade during the weekends, okay, that is something that at the moment, okay, right, you don't have.
I don't have that. And then I've never day traded. So I never day trade anything, and I never take, I think for me, I'd rather have a large position that I have conviction in than to have it spread out into smaller trades.
It makes perfect sense. But I tell you, when we talk in the context of treasurers, I mean, they have the ability to have a microstructure of the market 24 hours, 7 days a week. And you actually have the weekends, and you have a large volumes. I mean, and then what actually happens is that then the result, or the flip side of that, is that you actually have all these different anomalies that are actually there that are fairly interesting to your AI stuff that I'm sure you actually gotta go through.
Okay, let me tell you why I don't do that. I tend to not sleep more than 4 hours a night, and I don't even get to, and I'd rather, on the weekends, I would rather just do my own stuff. So I actually like when the market's not running.
But the problem is you get hooked into it, and then you're going to be...
and it's been a wild 8 years. So look, I love talking. We will talk more about this, but this is brilliant. Congratulations.
Great. Thank you. Very, very, very good to meet you. Thanks so
Awesome.
much. I appreciate it. Appreciate it. Bye.